There's a mathematical formula that tells you exactly how much to risk per trade to maximize long-term growth. It's called the Kelly Criterion, and it's been used by professional gamblers, hedge funds, and mathematicians for decades. The formula is simple. The concept is powerful. But here's the problem. Full Kelly is too aggressive for most traders. It maximizes growth, but it also maximizes volatility. And volatility kills psychology. So the question isn't whether Kelly works. It does. The question is whether you should use it, and if so, how much of it. Here's the formula. Kelly percentage equals win rate times risk reward minus loss rate divided by risk reward. Example, 40% win rate, 1 to 2 risk reward. 0.4 times 2 minus 0.6 divided by 2. Result is 10%. According to the formula, you should risk 10% of your capital per trade. And that sounds insane. Because it is. Full Kelly assumes you have perfect information. It assumes your win rate and risk reward are constant. It assumes you won't make mistakes. It assumes your psychology can handle massive swings. And none of those assumptions are true in real trading. Your win rate fluctuates. Your risk reward changes based on market conditions. You make mistakes. And your psychology breaks when you lose 30% in a week. Full Kelly doesn't account for any of that. It's mathematically optimal in a perfect world. But trading isn't a perfect world. And what's optimal mathematically isn't always optimal practically. This is why most professionals use fractional Kelly. Half Kelly means you risk half of what the formula says. Quarter Kelly means 1/4. If the formula says 10%, half Kelly is 5%. Quarter Kelly is 2.5%. And the reason you fractionally reduce it is to smooth out the volatility. Full Kelly maximizes growth, but it comes with wild drawdowns. Fractional Kelly sacrifices some growth for stability. And stability is what keeps you in the game long enough to compound. You'd rather grow slower and survive than grow fast and blow up. Let's compare. Full Kelly at 10%. You compound fast. But when you lose 3 in a row, you're down 27%. You're trying to trade out of a nearly 30% hole. That's the cost. Fast growth but brutal swings. Half Kelly at 5%. Growth is slower but drawdowns are manageable. 3 losses in a row puts you down 14%. Still painful but recoverable. You're not in panic mode. You're executing your process with a stable account. Over time, the consistency of half Kelly often beats the volatility of full Kelly because you don't blow up or quit from psychological damage. So should you use Kelly? Yes, but fractionally. Start with quarter Kelly. That's the most conservative. It gives you enough edge to grow, but keeps your risk per trade low enough to survive variance. If you're experienced and your psychology is strong, move to half Kelly. But never full Kelly. The math says it's optimal, but the reality is that full Kelly will destroy your account or your psychology before you get to see the long-term compounding. The formula doesn't account for fear. It doesn't account for tilt. It doesn't account for the fact that you're human and humans don't execute perfectly under stress. Here's how to apply it. Calculate your Kelly percentage using your actual win rate and risk reward from your last 100 trades. Then take half of that number. That's your position size. If Kelly says 8%, you risk 4. If it says 6, you risk 3. Stick to that until your stats change. If your edge improves, recalculate. But don't chase full Kelly. The edge you gain from faster compounding isn't worth the risk of ruin or psychological breakdown. Kelly Criterion is a tool, not a rule. It shows you the theoretical maximum you could risk. But theory and practice are different. In practice, you need margin for error. You need buffer for psychology. You need room to survive the variance that the formula doesn't fully account for. So use Kelly to guide your thinking, but use fractional Kelly to guide your execution. Quarter or half. Never full. Because the goal isn't to grow as fast as possible. The goal is to grow consistently without blowing up. And that happens when you balance the math with the reality of human trading.